Hey everyone, welcome back to another episode of my M1 Finance portfolio series where I'm attempting to reach a $100,000 portfolio in this platform M1 Finance. And we're 3/4 of the way there, a little bit over at about $76,000 or almost $77,000 in the account when you add the cash and then the current value together. And that's after giving up a few $1,000s worth of gains in the last few months, which hasn't been particularly fun, but hey, it's opened up some different buying opportunities for me. I guess I don't need the money anytime soon anyways. But if you guys want to check out M1 Finance, it's free to open an account. I always include an affiliate link in the description below, and I'd appreciate it if you checked it out. If you end up funding your account, it could go a long way towards helping the channel. But in this video, I want to go over the spectrum that is business quality versus price, since I think there are kind of some misnomers that are thrown around, often quoting Buffett, and I want to address some of these. So we'll get back to that in just a second. But for now, let's take a quick look at what happened with the portfolio. I have been adding quite a bit of money into Turtle Beach recently since it dropped all the way back down to the low 20s, which is around my buy target. It's actually below my cost basis right now. My average price per share is at just under $24, and it's hovering in the $21.43 range. I think Q4 earnings, which will be coming out very soon, will be very telling as to what trajectory Turtle Beach is going to be following for the foreseeable future. And that's because they're dealing with all sorts of supply chain issues, but so is pretty much every company. But they basically attempted to overstock their inventory over the last couple of quarters, so their cash flow hasn't looked that great. But if they have a good Q4, their cash flow is suddenly going to look all that much better. They're already projecting something like $30 to $40 million in EBITDA, which is pretty much in line with what they were expecting to do this year anyways, so I would be pretty satisfied with that result. So we'll see what happens. Low cash flow because of stocking up on extra inventory seems a lot more attractive to me than losing a bunch of money to debt or fraud or something like that. In short, I think even though cash flow didn't look very good last quarter or the quarter before that, I think this Q4 is going to be a very different story. But again, time will tell. So looking ahead to next week, I'll probably be looking to buy some more Turtle Beach, even though I've already added a few grand to it very recently. But since it's in kind of my buy zone, I want to be adding while I have the chance. But going back to the value slice of the portfolio, I did add a bit of money to Foot Locker as well as to Sleep Number, and I think I added some to Smith & Wesson fairly recently, but not very much in the grand scheme of things. Most of the investments I made over the past month were towards Turtle Beach. And otherwise within the portfolio, I did add a tiny bit to Alibaba, which is finally coming up from the depths since, let's see, my average share price is at $151.50, and it was as low as like 110, and now it's up to 131 again. So we'll see what happens with Alibaba and really Chinese stocks in general as time moves forward. I don't really want to add a whole lot more money to this, at least while the portfolio is this size. Maybe as the portfolio grows, I'll kind of add a proportional amount towards Alibaba as long as it's around the same price, but who knows what's going to happen in the future. But that's kind of my thinking here. I don't really want to over allocate towards specific individual Chinese holdings just because it has a unique set of risks, and I've discussed them briefly on the channel. Really more of a clone following some of the super investors out there that have invested in Alibaba. The numbers on the surface look very promising, and the thesis is definitely there. So we'll see what actually plays out in the future. It's just that it would definitely take a lot of due diligence to really understand this business because Alibaba is very much a conglomerate, and there are lots of different subparts. Plus, being in the US and this being a company all the way out in China, I don't have the luxury of being able to use their products on a daily basis outside of a few of kind of the US facing products like AliExpress or those sorts of things. But for my portfolio's sake, it's good to see that Charlie Munger has doubled down on Alibaba. And since that news, it seems to have turned a corner, but we'll see what really happens long term. But just as always, I'll be looking to add more money to this account as we keep moving forward. But now, as I promised earlier, I want to talk about this spectrum here, this little graphic I created. I'm very proud of it. And that is this relationship between the quality of the business and the price of the business. Because we often hear the famous Warren Buffett quote thrown around all the time. It's one of his sort of mantras, and that's that you want to buy a wonderful business at a fair price as opposed to buying a fair business at a wonderful price. And I think that's often how people frame it in this sort of binary way, for better or for worse. Either you have to buy a wonderful business at a fair price, or you have to buy a fair business at a wonderful price. There is nothing in between, and there's no gray areas. But as with pretty much everything, there are lots of gray areas, which I've attempted to illustrate in this beautiful graphic. So the x-axis here is price. As we move towards the right, the better the price, the the better the deal you're getting on that particular business. And then the y-axis here is the quality of the business. So as we go up, that takes us to the more wonderful businesses out there. And notice how we see Warren Buffett plotted right here at the top, looking for a wonderful business at a fair price. And we can see that fair is this middle point right here for fair prices and fair businesses. The closer you get to the middle, that's what you're going towards. But I think the Buffett quote often misstates what investors are really going for. And that's what Warren Buffett's probably going for all the time too. And that is a wonderful business at a wonderful price. The problem is these hardly ever exist and this hardly ever comes up. But I guess on super rare occasions, this does occasionally happen, maybe once in a generation sort of opportunities. Oftentimes, there's going to be some sort of overarching level of risk that hurts the business quality, but at least we can establish this as the sort of pie in the sky goal. This is what everyone really wants. So where do we go from there? Warren Buffett would say you want to go for those great businesses that can really make it through thick and thin. Even if you're paying up a bit for them, getting them at a quote unquote fair price, you should still end up okay as long as the business truly is a wonderful one. And that's really what the Berkshire portfolio has turned into. It's a lot of very large, successful companies that probably aren't going anywhere. And sure, they might not be trading at deep discounts and often are trading at premiums depending on who you ask, but they're probably not going anywhere. And they've treated Warren Buffett quite well over the past few decades. But the funny thing about Warren Buffett is that's not really how he was always investing. He often was down here towards the right side of this chart, going for the wonderful price, the big value plays, deep value plays as they're often called. Those businesses that might not be great, fair in this case, and you can get a steeper discount that way because people might not view that company as a wonderful company. And that's including Warren Buffett himself. He'd often go down into the terrible business side of things, this bottom right quadrant, where you're trying to get these cigar butt type companies. That's what he's described them as, in that there's not much life left in these businesses, but there's plenty of assets in them, and you can get those assets at a significant discount, get the last puff out of the cigarette, as he has metaphorically said, and that's how you get your profits, and then you just kind of discard the rest of the business. Or maybe you do some sort of spin-off or some way to capture that remaining value, but you're really not relying on the long-term prospects of the business like you might up here with a wonderful business. So does that mean that you should always avoid terrible businesses? Well, it totally depends on what your goals are. If you're getting something at a wonderful price, it's inherently a good deal at some level, even if it might not last forever. Maybe you can extract a good amount of value, even though it's a quote unquote terrible business. And that's why I've shaded this area gray, have this question mark here, because it's not always so clear that you should avoid these sorts of companies. Maybe this is a special situation where there's some sort of turnaround in the short term. It maybe won't last for super long, but if you can extract some sort of value out of it, some sort of business play, a spin-off, whatever it is. The point is you're buying something at a very steep discount to its intrinsic value, even if that intrinsic value isn't all that high. The discount is really what you're focusing on here, and that's where you're going to get your returns. Whereas over on the wonderful business side, you're not really getting your returns from the discount, at least in the short term. You're really getting it with the business growth and the strength of the business to get through all sorts of situations. But we might as well talk about the other half of the spectrum. What about a wonderful business at a terrible price? Now, I would argue that anything that's a terrible price probably is a terrible investment, but you could make an argument that a wonderful business at a terrible price could sort of pull its way out of the terrible price because it could do something unexpected. It could do some sort of spawning event, as someone like a Monish Pabrai might say, where it creates a new business segment or somehow grows in a very rapid way in some magical way. Maybe there's a fantastic capital allocator at the helm, and that person's able to take the business to unfathomable heights that you wouldn't have really predicted. Now, and again, make an argument that you're not really paying a terrible price in that case. You're actually getting a good deal. You just might have not realized it. But how predictable is this model? I'm not really sure. That seems a lot harder to do, at least on a repeatable sort of basis. So it's up for you to judge that risk. But down in the bottom left quadrant, I think we can objectively say that these are the bad deals, the terribly priced businesses that are also terrible businesses, the ones that don't have great quality and you're paying a premium or you're paying above what you probably should. You're not getting a discount to the liquidation value. You're not getting any sort of discount here. So what's the point? These might be the businesses that are declining rapidly with no signs of turning around. Maybe they're unprofitable with no sort of prospects for growth. There's all sorts of companies that could fit in here. Fraud, whether discovered or not, could be something that destroys these companies. Point is, this is something that all investors want to avoid. And I think it gets very difficult for some people to avoid these companies, especially during times of euphoria where everything seems good. You're not really checking, doing your due diligence on a company. You're just seeing the stock price move. You're buying into it based on that alone. And you think that's going to make for a great long-term investment. investment, when you don't do your due diligence at all, this is often where you're going to run into this sort of thing. So of course, you could do your due diligence and you still end up with one of these companies. I'm just saying it's less likely if you actually do it. Now, when it comes to my investing strategy, of course, I'm going for this target up here. But like I said, those opportunities are rare, if not almost impossible to actually get, at least on any sort of reliable basis. You never really know when these things are going to come up, but you could say that about most forms of investing. You never know when the next deal is going to come. So this is what I'm going for, this top right up here. But really anything to the right of the price line, at least at my current level, probably would make sense, at least for those businesses which have futures that I think are reasonably predictable. It can be easier to figure out what that wonderful price is. And when you can do that, you can really weigh the actual probabilities of this investment working out and your expected returns. But again, nothing's guaranteed. You're really just playing the probabilities and trying to go for the things that are more likely than not to happen. And especially as a smaller investor where your universe of opportunities is a lot larger than someone like a Warren Buffett who has to move $100 billion in cash, it doesn't make sense for him to go for some $10 million textile company that's trading well below what it really should be based on its liquidation value or whatever it is, because that's not going to move the needle for him. So Warren Buffett has a much smaller universe of opportunities than someone like you or I who does not have $100 billion to move around. And if you do have $100 billion, definitely let me know. So if you find a quote unquote terrible business that's at a wonderful price and you think there is a reasonable likelihood that that value can be extracted in some way, then why not go for it if that would really move the needle for your portfolio and you think it's more likely than not to happen? I don't think it's worth overlooking all those potential opportunities just because you read a Warren Buffett quote somewhere. But whatever you do, it ultimately comes down to your preference for investing. Maybe you want to take the Buffett approach, looking for those wonderful businesses at fair prices. Maybe you want to go for more of the sort of Ben Graham approach that really Warren Buffett was spawned out of. And that's going for businesses that might be much less in quality, but are trading at a steep discount to whatever their intrinsic value might be. Or maybe you're somewhere in between, or maybe you prefer to just overpay for everything. In any event, I'd love to get your thoughts in the comments below. Otherwise, that's all I've got for today. So if you like this video, please like it, since that would help the channel out a lot. And if you want to make sure you don't miss the next episode of the series, be sure to subscribe and hit that bell icon so you get notifications whenever I put out a new video. I put out new videos every single week. And check out the free stuff and the affiliate links in the description below. But until next time, take care.